2026 housing market outlook here in the Greater Lafayette area, here in Lafayette and West Lafayette, Tippecanoe County, and the Greater Lafayette area. And full disclosure, to guide this discussion, I'm using a housing market outlook that was published by the Compass real estate conglomerate. They are one of the largest out there now. In some markets, they have more than 50% of the market. But as I was going through to find the data to guide this conversation, amongst all the various sources that I found, this one does a good job of putting all of the data together in a logical fashion that can help shape the discussion. And they cite their sources, is the important thing. This isn't just sales and marketing material. This is cited sources going back to the data. Let's go to the top. And this will be a little start and stop. To start with, we got to talk about the nationwide, even the worldwide backdrop of what the market looks like. I like to say a lot that all real estate is local, and that is a very true fact. But we do not just live in a bubble. We've had the lock-in effect over the last several years where existing homeowners have cheap mortgages, historically cheap mortgages, and some as a result of that, but also a result of the lock-in building tons of equity. Whereas buyers after 2022 definitely have higher payments because of higher interest rates and have not had time to build a lot of equity. Rental rates have been climbing. They've been climbing nationwide. In New York at about a 4% rate. In some other markets, closer to 1%. But here in the Greater Lafayette area, they have definitely been, those prices have definitely been growing. And the combination of not enough homes on the market here in the Greater Lafayette area has driven those increases in rental prices. And you get into this catch-22 of you're always constantly trying to catch up. Your rent's going up. If you would have bought a house, your mortgage isn't going to go up. Could your taxes go up? Could other things go up? Could your insurance go up? Absolutely. So let's move on here. We're starting to see a little bit of the signaling of improvement of affordability. I did not say that things were affordable. I did not say that things are affordable. One, I'm not placing a judgment on what is affordable and what is not affordable. There are some accepted formula that show what is typically, in economic terms, been affordable and not affordable. But nationwide, we're starting to see improving affordability. Now, what does that mean? That doesn't mean that house prices are coming down. And for everybody that complains about, house prices need to come down, I counter with, do you want the value of your house, of your investment to come down? I don't think a lot of people do. Price increases have begun to slow, which means that wage increase is starting. It's not there, but it is starting to close that gap. Could that turn around next year, next month? Absolutely. Here is the data that backs it up. We're looking at home prices as a ratio to income. And we're looking at national data here. And we can see that in 2022, it peaked at about 5.5, what this chart is calling severely unaffordable. Home prices are more than 5 times income on a national average. We can see that has started in 24 and trending in 25 to come on a downward trend. Again, starting to come down. I did not say affordable. If we look at this chart, we can see that it is broken into three areas: severely unaffordable, which is where we have been; less affordable, which is where the chart goes back to all the way back to 2010, and affordable. Affordable being home prices at 3 to 4 times income. So if your income, using round numbers here, is $100,000, then an affordable house would be $300,000. At less affordable, if you're making $100,000, then housing would be at $400,000, and then $100,000 income, a $500,000 home. These are all the same home, of course, that we're talking about. So this is just an illustration of what affordability is starting to do. Now, will it continue that way? Oh, we sure hope so. But there's, I was going to say, a chicken and egg problem here, but that's not quite right. The problem is, and we're going to start talking about mortgage rates to illustrate the problem. With flat prices, buyers might think, you know what? I'm going to wait for prices to go down a little bit more. I'm going to wait for APR to go down a little bit more. Perhaps they don't go down. Perhaps rates start to go up. But then we talk about mortgage rates. We've been living in the 6 to 7% rate on 30-year mortgages for the last year and a half, and it only dipped below the last year and a half, but all the way back to October of 23, it spiked up close to 8%. It was about 7.8%. And the last time that it was really below, that the mortgage rate was below 6%, was back for a sustained period of time, was back in September, October of 22. Now, what just happened? If you've been watching the news at all, we've seen mortgage rates dip below the 5% level. I have a live chart here. This is from Mortgage News Daily. Here's the 6% line. I am currently looking at 30-year fixed rate mortgages, and we're at about 6.01%. We're not quite below 6%, but for all intents and purposes, we're there. Now, if we go to 30-year FHA, and there are advantages and disadvantages to FHA, and not every house and not every buyer is going to be FHA approved, those are actually sitting below 6% at 5.7%. And then just for comparison, 30-year VA, if you're a veteran, I cannot overly emphasize the importance of exercising your access to your VA mortgage. Currently sitting, as of earlier today, 5.71% on a 30-year VA. So if you watch the news at all, why are these mortgage rates coming down? There have been some macroeconomic pressures that have slowly starting to ease that. We can see that we were living up at the 6.5% for the better part of 2025, and it slowly started drifting down over the last half of the year, the last quarter of the year. Then suddenly we get this relatively big bump for the time period. There are what could generously be classified some factors in the news, in current events, that are driving that. It's entirely possible that some of those more controversial issues that are out there might bump it back the other way. Again, I don't have a crystal ball in front of me. I'm just saying, when things are as controversial as many things are right now, it really gets hard to make predictions. Predictions are based on rational data. So, continuing on, we have reached the point that nearly 20% of all mortgages have greater than a 6% rate. Why does that matter? It matters because if your rate is greater than 6% and the rate is 6% or in the neighborhood of 6%, it is not more for you to go out and get a mortgage on a new home. You're not locked in. Why is that? People might want to stay in their home, but sometimes people don't have a choice but to move. And I'm talking about people that get married, have babies, kids that go off to college, leaving empty nesters. You have divorce. You have people getting new jobs, maybe in a new city, maybe in a new state, moving for school, for higher education. If you're in Greater Lafayette area, perhaps you're coming here to pursue a PhD at Purdue and you're going to be here for a number of years. Sometimes people are forced into moving. So nearly 20% of people now have a mortgage that is greater than 20%. The average rate of outstanding mortgages, and this is nationwide, is 4.5%, and the current market rate is 6.1, 6.2%. We are nearing that crossover where the bulk size of outstanding rate is going to be larger than the current rate. Here's the chart that I'm looking at that shows that. We're here at 4.5%, and this is the national average of outstanding mortgages. And then the current market rate, 6.2%. And we can see that this has been living in this opening here, a spread of 2 to 2.25%, 2.5%. We're not at the crossover. We can see that we had crossovers back in 2018, again in 2019, and again in 2022, heading the other way. We're not at a crossover yet, but we're headed there. This is all a lot of deep data. Like I said, this is a deep dive into what the market looks like and what it's going to possibly look like here in the Greater Lafayette area in 2026. Our days on market have been increasing. In Indiana, and this is for all of Indiana, it has been up to 61 days, just about a week and a couple of days shy of 10 weeks. At the peak in West Lafayette, it was 2 to 3 days. You could have your house listed on Friday and have it sold by Saturday or Sunday. That has stretched out. We're seeing more inventory on the market now than we have seen in a while. The total number of inventory is going up. However, that is largely being driven by the fact that houses are on the market for a bit longer than they have been. There are not more houses coming on the market at any one time. The input is staying at about the same rate. It is the output that is taking a little bit longer to move around. I expect to see that continuing for a good part of 2026 here in the Greater Lafayette area. We are, in addition to houses sitting a little bit longer, we are starting to see homes actually come off of the market. Seller put them up for sale and they didn't sell and they've decided to withdraw them. Maybe they decided to come off the market and go back on the market as a fresh listing, get some new attraction, new attention to that listing a couple of months later, maybe in a better season for the seller, perhaps changing plans. But we are starting to see more homes come off the market, and nationwide that number is up. And in Indiana and in Greater Lafayette, that number is up. Now, the number of people buying homes is staying about the same. And this is one that I wanted to really highlight. This comes from the Mortgage Bankers Association. 13-week rolling average, so 3 months. The blue line is 2025. Check that out. Almost flat. 2024, it was almost flat. 2023, it declined. 2022 is where the real declination happened. That's the yellow line here. So we got here at the end of 22. We lived there for most of 23. That's the red line. We continued on down. 24 held about steady. And then we come back in 25 and we're starting to grow, and we're about to hit that crossover point, that of the low point of 2022, and hopefully start growing. So the number of mortgage applications has been holding steady for a number. It declined in 22, and then in 23, continued to decline a little bit more in 23, and then in 24 and 25 held steady, a little bit of growth towards the end of 25, and hopefully we will start to see that growth increase. Why is that important? That's important because now we're talking about more buyers coming on the market. I'm going to wait till mortgage rates come down. I'm going to wait till prices come down. Here's the news. Here's the takeaway. Prices are not going to come down. They will hold steady, hopefully, and not increase quite as fast as they have been. As mortgage rates do what they're doing right now, more buyers are going to enter the market. What does that mean? That means that competition is going to become fierce. It has been fierce for those buyers that were in the market, but as more buyers enter the market because they think they're getting a deal with a better mortgage rate, they're going to find more buyers competing with them, and then guess what they're going to get into? They're going to get into a multiple offer situation. A house is going to go on the market in walking distance to Purdue University, in the West Lafayette School Corporation, in Lafayette, close to Nanshan Aluminum on the south side. A house is going to go on the market on a Friday, and they're going to have 10 offers by Saturday morning. And you know which one's going to win? The person that offered the most money. And then we're off to the races. What am I saying? Am I saying you shouldn't buy a house? No. I'm saying that the best time to buy a house is now. Not later, not some other time, but right now. Because we have the market for now. What's the market going to be tomorrow? Could be better, could be worse. Does that make sense? I think that makes sense. All home sales nationwide, and this is the top quartile, $1 million and above, now represent almost 20% of the market, 19.1%. That percentage is not quite as high here in the Greater Lafayette area. I hear a lot about, hey, institutional buyers, cash buyers, putting pressure on the market for those who have no other way but to finance through a traditional mortgage. And those are not untrue statements. I do understand and do agree, sympathize with those facts, but cash buyers by price range, and again, we're looking at some nationwide data, but cash buyers by price range. Check out this one. Basically, it's about 20% of buyers from $200,000 on up to about $1 million. It gets up to about 26%. And then it grows to 35% at $1 million and then hops up to north of 50% at $2 million plus. How many homes do you think are north of $1 million here in the Greater Lafayette area? Oh, they exist, but it is a very small percentage. And then the number of homes that are 2 million and above is a very small population indeed. And I think the highest house that sold last year in the Greater Lafayette area was somewhere just under 5 million, and that was one house. So like the 10 million bar doesn't even really apply to us. I went through and I checked these stats against the MLS data for last year, and the general trends track. It's actually a handful of percentage points under this. There's 3 to 7 percentage points difference in the local data versus the national data. At 22% nationwide, it might have been 16 or 17% here in the Greater Lafayette area. So not even 1/5 of the homes in the $200,000 to $350,000 price range are going cash. And I think that's going to continue to hold, and that's going to continue to be the way that it goes. And the bulk of our homes here in the Greater Lafayette area are below $500,000. Yes, there is a good population of $500,000 to call it $800,000, indeed even 800 to a million. There's a good population of homes. But the bulk of homes here in the Greater Lafayette area really live in the $0 to $500,000 range. If you are a cash buyer, fantastic. Let's go and write some offers. Let's buy you a house. But if you're not a cash buyer, you shouldn't let that stop you. And as a matter of fact, you also shouldn't let the thought of 20% down stop. Will 20% down buy you a better interest rate and perhaps buy you a lower payment? Yeah. There are so many great programs out there from the big hitters that everybody knows about. FHA and VA. The state of Indiana has some great programs that help with down payment assistance in some cases and give grants for that. There are some programs that help lower the cash that you have to bring to the table. Hoarding cash for a down payment is not in and of itself a barrier to entry to owning your own home. If you are interested in finding out more details about any of this, go to the LafayetteReal.com/YouTube and fill out the form, and you'll hear from me directly, not somebody else. You're going to hear from me. That's the LafayetteReal.com/YouTube. So what does 2026 really look like? There's no simple answer. I don't have a crystal ball. Of course I don't. Affordability, still difficult. House prices are up. Income has not kept up with that. Hopefully, as price growth slows, income growth will start to close some of that distance. I get it. Everybody wish they were pay more. We wish that corporate America, we wish that everybody was able to pay more right now. But hopefully that will start to get some of the problem taken care of. As people start to move even more than they have had, as we talked about earlier, people have always had to move because they're getting married, because life changes, they're having kids, jobs change. Now we're going to start to see the people that were locked in over mortgage rates start to go, you know what, it is time for me to go, or I just don't care anymore. I want to go live somewhere else. The labor market is definitely going to affect all of that. Does the labor market soften? It might, but in that vein of real estate is hugely local. Our local economy here in the Greater Lafayette area has been strong, and for the moment continues to be strong. For all the controversy of SK Hynix coming to West Lafayette, it is a signal of a strong, healthy economy. We have all of the new companies that have come to town over the last few years, GE Aviation and Saab, Nanshan Aluminum. We have the companies that have been here for longer periods of time, decades upon decades in some cases. We have Caterpillar and Subaru. The manufacturing economy is strong in the Greater Lafayette area. And we have a gem of a research university, Purdue University, that is helping drive some of this. Now, are all of these companies coming just because of Purdue University? No, but it certainly helps. Case-Shiller has a fantastic database of home price changes, and when I talk to people about home prices and they talk about how long is it going to be before home prices go down and correct, they have gone down 3 times over the last 40 years. In 1990, about 2.2%. In 2008, this was the big one, about 27%. You'll all remember that one. And 1 month in 2023, they dipped into the negative as the pandemic boom came to a close. Here's Case-Shiller's prediction of what home prices are going to do in 2026. We can see those 3 drops. Here we are in the 90s. Here we are in 08, in 22, 23. And here's our forecast. So we can see home values went up to 20% in 2020. They had been hovering around 3 to 5, getting up to about 6-ish% here in the late teens, and then really spiked. but we came back down to earth and we've been living in that same range. Case-Shiller's prediction gives 3 points of reference. Could be 0.5% is their forecast, but statistically it could be a little higher in the around 3 to 4% range. It could drop negative briefly again down into the -2, -3% range. We don't know what's going to happen. We don't have a crystal ball. We can't say for sure, but the statisticians are able to look at the past data and then assign some probability to the data that is driving these, and then make some best guesses on what's going to be happening in the future. We're talking about 4.6% at the high, 0.5% as the forecast, and -3.6% at the low end. I'm a fairly big believer in medians and averages for most data, so essentially flat, that 0.5%, maybe even a point or two above that, so a little bit of growth. So what we're seeing right now, home prices starting to hold steady. We're starting to see mortgage rates drop slowly, oh so slowly. We're starting to see more people having moved, and so that percentage of mortgages that are certainly greater than 2%, but are in that 5 and 6 and 7% range, just bulk percentage of people nationwide that have those mortgage rates is as large as it has been. So people are going to continue to move. The market is going to do what it needs to do. Greater Lafayette is going to continue to perform a very healthy level. Now, we're starting to see some price reductions, but I would argue that the price reductions that we're seeing are not, for the most part, driven by the market. And what I mean by that is I think a lot of the price reductions are being driven by sellers who wanted to try to, from the most positive standpoint, make the market. They wanted to define the price for their home. And the reality is the market defines the price. Most of the price reductions that we're seeing here in the Greater Lafayette area are because of that. Now, are there homes where they're not selling because pricing has come down? Sure. Inevitably, there is probably some other pressure on it. There are local market factors. SK Hynix is starting to be, I think, a pressure point on some homes around the area for sale. There are lots of factors that go into that. So there you go. All right, I have gone on and on long enough. Let's wrap this up. New home sales here in the Greater Lafayette area have really been anemic, and they have been anemic nationwide for the last 2-3 years. If you've watched the channel, if you've watched the show at all, you have seen us jump on the announcements of a number of new build neighborhoods. There is one neighborhood of almost 1,100 homes by one developer coming to West Lafayette that is breaking ground very soon. There are a number of 100, 200, 300, 400 home site neighborhoods in Lafayette and West Lafayette that are breaking ground. This year, there will be permits for several hundred to north of 1,000 homes breaking ground here in Tippecanoe County. We're finally going to see more new homes come for sale, become available. That's going to increase the number of total homes that are available in the market. So we're going to start to see some stability in 2026 is the forecast. We're expecting home prices nationwide to be essentially flat. We'll probably see a little higher appreciation here in the Greater Lafayette area. It's not a crash and it's not a boom. It's just the market dealing with accumulated imbalances over a number of years of factors that have driven us to this point. Most of the analyses when they were written towards the end of the year were expecting to build in mortgage rates of 5.9 to 6.9%. We've already touched that 5.9% rate already. Will that continue on down and just shred all of these analyses that were done? We're gonna find out. For sellers, you really have to price it right. You don't want to get into a situation where you go on the market with an overpriced house and then it goes stale and then people start wondering what's wrong with it. Listen to your realtor, get your price right on the first time. Go to the LafayetteReal.com/YouTube, fill out the form, and I'll get back to you and we'll work on it, the correct valuation for your home that you need to sell now before you can move into your next home, whether that's your next home here in the Greater Lafayette area or whether that's your home somewhere else in the country, somewhere a little warmer, maybe in Texas or Florida or California. Don't forget to hit the like and subscribe button so that you don't miss a minute of content that we put out here on the channel.